Hello guys, there are 5 growth and value stocks which I think are at discount now, and I'm trying to build position with these. I'm waiting for the better opportunities in some of these, but overall I'm starting growing positions, and I think that it should be interesting to share it with you. Yeah, some of these are proven giants and some of these are new disruptors, but all of them combine the real business momentum with the price the market is discounting. I'll walk you through the story of each business, why I'm thinking that they are cheap, the key numbers, and the big growth triggers I'm watching before I buy for my portfolio. Just a reminder that I'm building the new portfolio and my focus is really simple: strong business and long runway, clear path to the free cash flow, and valuation that bakes in pessimism instead of perfection. So the first stock is Amazon, and who is watching my videos, they probably know that it's the biggest position of mine, but in last few weeks we saw that Amazon fell about 10%, yeah, even 11%. So I believe it's a good opportunity to buy more. If I will be buying it more, I am not sure because it's the biggest position in my portfolio already, but I will be definitely considering it. The main reason why Amazon is in my top 5 list is because I'm thinking that it is one of the greatest companies in the world, and also the re-accelerated growth of AWS and AI. So I'm thinking that this is a great opportunity. Yeah. If we'll take a look into the valuation, PE for Amazon is 32 and 12. I would say it's a little bit high for the smaller companies, but for the Amazon multi-trillion company, which is growing double digits, I would say it's still on the discount, and the forward PE is 28. This is really a good number. It shows that they are still growing. Yeah. If we'll take a look into the EPS this year, it is about 30%. It's a really great number for Amazon. And the gross margin is 50% for the Amazon, which is really deep into sales, not only software. I would say it's a great margin, and the profit margins are both 11%. So yeah, I think it's a really good number. And just remember, PE 32, Amazon is valued cheaper than Walmart, and Walmart profit margin is about 2% or something like that. I don't remember very well. Comparing to Amazon, which is 11, it's a huge difference. I would never pick the Walmart. Next stock is Uber, and I think it's 5th position in my portfolio. I was starting to buy it somewhere here. It was growing very nice, and now it's fell even more. And this fell started on the fears of the robotaxi from Tesla, and as you see, it fell about 20%. Yeah, and I don't believe that Tesla will disrupt the market so much, because there is Waymo already and Uber is still fine, and Waymo is much bigger than Tesla for now, and Tesla growth will not be so fast. So I believe that in the next years Uber still can show really great results. And what I love about Uber, that the revenue growth is above 18% year over year. So I believe that there are some fears now, and maybe it will have some hate for a while, but I don't believe that Tesla will be growing so fast with a robotaxi. We also have Waymo on the market, and Uber is partnering with Waymo, and with this discount now, it can grow parabolically later. So we just need to be patient here. Yeah. And the second point, I love to have market expansion into delivery, freight, and advertising, which adds higher margin revenue streams on top of rides as the network gets denser worldwide. And if we'll take a look into valuation, PE for Uber is 10. I think it's ridiculously cheap for the company, which is growing 18% year over year. And the forward PE is 22 and 6. It's just higher because of the drop now. And if we'll take a look into the EPS this year, it's 17%. I think it's really good too. Yeah. Gross margin is 32. It's not super high for the software company, but it's still all right. And profit margin is 33. It's a really great number. It's higher than the gross margin. Yeah. So I don't believe that it will be disrupted so fast. Maybe it's not super long-term investment, maybe it's for the next few years, but for the next few years I don't think Tesla will just dominate on the market. As I mentioned before, Uber is collaborating with AI-driven companies like Waymo or WeRide as well, and they still have food delivery. They're planning to work with the freights, so I believe it still has a great future. And next stock is Duolingo, and as you see, it dropped over 70%. Yeah, And it's probably fair because it was overpriced too much. And even if the numbers are really better than they were before, they're growing over 40% yearly and they're becoming free cash flow positive as well. The stock is much cheaper now. I have two biggest growth triggers here, and one of these is AI part personalization. Duolingo uses generative AI and proprietary learner data at the core of the product to boost engagement and upsell premium tiers like Duolingo Max as well. And the second trigger is new subjects actually. Duolingo is not only language learning platform now. They're expanding beyond languages into math, music, and even chess. They're launching over 100 new courses in 2025, which opens completely new market while leveraging the same app and brand. Valuations for Duolingo are really great in my opinion. The PE is 23 and 6 now, and it's really cheap for the company which is growing 40% yearly. The forward PE, some sources are telling that the forward PE can be even 100 just because they're expecting the growth will be really rapid for them. EPS this year is 331%. It's really a high number in my opinion, and the gross margin is 70%, which it is really good for the software company even, yeah. Profit margin is 40%, which is really great too. The next company is Hims & Hers. It's a telehealth company and direct-to-consumer platform that's been expanding aggressively into new categories and geographies. To be honest, I think it is the most riskiest company I'm telling about here today. It fell about 48% and I still don't have it in my portfolio, but I'm going to buy it if it will fall below 30s. And I really hope it will because I believe in this company. I was using some of their products like finasteride because I don't have too much hair and so on, and I really like the service. And what I love about this company that they're projecting growth about 60%, so expectations are really high for this company. That's why I think it's a little bit risky and it's still a little bit too expensive to buy, yeah, but I believe that when it will be going below 30s, it will be a bargain, I think, even if the PE is really high. For me, the biggest trigger here is company expansion overall. Yeah, they are adding new treatments, they are opening the new markets, and they are increasing average revenue per user overall. This is a really good metric, yeah. And another trigger is a brand and subscription flywheel, first of all. As a telehealth becomes more accepted and team scales marketing efficiently, recurring revenue and cross-selling can drive both growth and margin expansion. And yeah, and I'm really expecting a lot from this company. Even if it's too expensive for me now, I will wait a little bit longer and I believe I will be buying into it. If we will dive into valuation of Hims company, we see that the metrics are much higher here. That's why I'm telling this is the most riskiest company of all of these. And I still want it to become a little bit more cheaper, but at least I can start to watch into that company already. If you remember, the growth of the company is projected about 60%, so 65 is a little bit high. I would love to have PE about 60, 55 maybe, and then I will start to consider it to buy it. And the forward fee is 59. It's already better, to be honest, and I already like it. So I want to wait a little bit more, and I really hope it will go a bit lower, and then I will start my position here. Gross margin is 65 for the telehealth company. I would say it's high, yeah. And profit margin is much lower, of course, because it's not a software company itself. They're selling the products, yeah, and 6%. It's still better than Walmart, and Walmart, I believe, is much more overvalued because the growth of Walmart is much slower than Hims company. And the last stock in my list is PayPal. This is money transfer and payment solution company. And this company is more about value than about the growth, but it's ridiculously undervalued in my opinion. If we'll take a look into performance in last couple of months, we see that PayPal dropped about 24%. And it is really cheap for this company. I still see the growth in this company. It's not like very fast growing company, but they're still growing about 8-9%. And the PE is about 10, something like that. We will take a look into that in the future. And they're making huge buybacks too. So I believe this company is a really good value company. Yeah, you will not get like the ridiculous growth here, but overall you can get about 10-15% really easy, I think. The biggest triggers for me here is that the new CEO strategy is focusing on the margin improvements, cost discipline, and product refreshness, which can let even to the high single revenue growth translate into much faster EPS growth as well. And the second biggest trigger is that the management guided that they will be doing about $6 billion shares buybacks this year. So the year is almost over, but still this is a huge number, yeah. And this can trigger the company growth as well, yeah, and EPS will be growing because of that, because they have less shares overall. Valuation for PayPal are really good. The company which is growing like 9%, 8% and PE is 12, it's really good, I would say, because if it wouldn't be growing, then I would say this is an alert, yeah. And forward PE is 10, and this, as I mentioned, is a value stock. It's not growing so rapidly and it's still lower than 12, so I believe it's a really good number, yeah, and I like it. And the service actually in PayPal is really getting better, so this makes me even more confident, yeah. Gross margin is 41 for the software. It's not the highest, but it's okay. It's not in green here. Usually when it's over 50, then it's becoming green, yeah, so I say it's okay. And operating margin is 19, profit margin is 15, so I believe this company is really nice. And some investors are telling on PayPal that this is a dead money company, but I don't agree, because it was growing as well. And if you take a look here, you see that this year it was much lower than now, and you could sell it maybe at 80s. And if we'll take like on the monthly, we will see that sometimes PayPal has like ridiculous growth. Of course, it was a COVID, the money were cheaper, but still I believe that it can grow up to 100 easily. So this was the list of the stocks I think are on discount now, and I am buying them in the future. I own some of them like Amazon, Uber and Duolingo already, but I will be buying more, and I still want to buy Hims and Hers and PayPal. So if you want me to deep dive into these stocks, just let me know. I already done Amazon and I will attach the link to this video. So just write in comments what stock are you interested in, and I will make a deep dive into this stock as well, and we can review that. And if you are interested in my investing journey and videos like this, just hit like, subscribe and leave comment. It will definitely motivate me to make videos like this. And yeah, just remember, keep growing, and see you next time.